Hello, today I will tell you about liquidity and what it is needed for, because it is literally the most important element in my trading strategy. This is what absolutely everything is built on, and understanding this element of my trading strategy, you will be able to work out and make very high probability and large transactions. You will improve your general understanding of graphics and context, why, what, where, and for what purpose. Liquidity is the ability to buy and sell an asset at any price on the chart. This is just the fuel that is absolutely necessary for any movement on the market, absolutely any. For ordinary retail traders, of course, liquidity has no value at all, but for large players it is vitally important. And if we are trading for large players, that is market makers, these big guys who manipulate the price, we must go into position just behind them to work out a cool movement. And to do this, we must fully understand the logic of their actions on the chart. They need liquidity in order to conditionally open a position for sale in this place. That is, he must first manipulate buyers, sellers, and only then open a position. Why can't it be done right away? For example, open a short here and fix the profit here. A large player has a lot of money, and therefore, if he takes and opens a position for sale right in this place, then in order to fulfill his application for the third short, the market will take absolutely all applications for purchase in the nearest places. Therefore, the price will simply take and fall down. There will be absolutely no buyer in all these places. The price will simply fall, and the average price of the sale will slip, that is, it will be somewhere here. And he will make himself worse, because he will open not here, where he wanted, but here. The profit is fixed, for example, here, and it can even go down. This is their problem. And in order to solve this problem, they just collect a bunch of liquidity, for example, from the same buyers, in order to open a short. That is, first they must manipulate them. And here comes the logic of inducement, that is, such an inducing movement that encourages people to open positions in the wrong direction, and at the same time takes the feet of the opposite traders. Here, when it removes this swing, that is, this inducement, it removes stop losses of those who sold here. Those who do not know, when a person, for example, opens a position for sale, he sells an asset which he does not have, so he takes it, so to speak, into debt at the exchange. And when the price closes his position on stop loss, he must buy this asset in order to get out of the position. He just buys it at a disadvantageous rate, so it goes down. The same if he closes it on take, he will simply also buy a position only at an advantageous rate, so he will earn, so to speak, such a spread. So, a large player, in order to gain a position further in the sale, he needs just a bunch of such stop losses of these traders. That is, orders, limits, stops, this is all liquidity. These are all such applications that are here. They come, they work. And in order for a large player to gain a position here, he goes on sale, right? That is, he sells an asset, and he must sell it to someone. And he sells it here to those who left the position here, that is, bought an asset. Because in order for people here to close on stop loss, get out of the position, or, for example, liquidate automatically, with us, buy their transaction, they must buy it from someone. That is, someone must sell it to them. And just here, a large player sells them assets so that they leave the position, and he, on the contrary, went in, and there were no slips, no too strong big impulses, because there is enough liquidity in order to enter the deal. That is, well, this is what I said at the beginning, that liquidity is the ability to enter at any convenient price on the schedule. That is, it is convenient for him to enter here. There is a lot of liquidity, so he can enter here. If he wanted to enter this place, on sale, right away, he would not be able to do it, because there is not enough liquidity in order to enter the short, and the price would just fly down. Why would it fly down? Because it would immediately take all the feet of these buyers who are here, who buy the asset. That is, a large player sells it to them. He would just eat everyone, and the price would just fly down, because there were no buyers left. The price would be right here, it would slip, he would enter incorrectly, and on the contrary, he would go down. Therefore, he creates the accumulation of liquidity, manipulates them, and only then he already works out his position. This is the main logic on which everything is built. In the future, there will be bites, inducement, fake formations, fake setups, because a large player, due to his weight, can create different false formations that encourage people to open positions in the wrong direction. For example, in this place. In order for him to open the short, we have already figured it out, he needs to take the feet of those who sold here. But in order to fix this position in the sale, let's not go into such details. Where he puts the feet, just understand that he entered, for example, in this place, and wants to fix the position for some super obvious purposes here. Sometimes, by the way, they also use the news in order to quickly reach their targets, for example, if there is no liquidity nearby. Therefore, the news is also a way to analyze the schedule. These are not some unpredictable movements. If everything is clearly understood, then the news can also be traded. So, in order for him to fix the position here, he also needs to reach this liquidity, because what will he do to get out of the short? Right, he will buy out the asset at a profitable rate, and accordingly, he will earn from it. Well, who will he buy it from? He will buy it from those who opened the opposite position here, that is, to buy, that is, longs. When a person opens a long position, he buys an asset, and when he is knocked out by a stop-loss here, he must sell this asset only at a non-profitable rate. It's super simple here, even easier than with sales. If he is closed by a loss, he will also sell, only at a profitable rate. He will earn this spread, this difference. So, when he is knocked out by a stop-loss, he sells the asset and sells it to a large player who opened a short here. Because in order to close the sale, he needs to buy out someone, the one who can sell it to him. That is, there are a lot of people, a lot of retail traders. Accordingly, it usually forms an obvious liquidity that will not be removed immediately. That is, here, for example, there is such a huge shelf of liquidity, a shelf of stop-losses of those who buy here. Here is some kind of support zone, or some kind of line that he artificially created to encourage people to buy here. Do you understand? There are just a lot of these stop-losses here, namely, the ability to close a short for him. Because when he comes here, in order to close the position, he needs to buy out an asset from someone. And then, bam, he just closes these people by the stop. They sell it all and sell it to someone. They sell it to a large player who buys out an asset to close a short. That is, with this logic it all works. The market is both buying and selling. These are only two players on the market, a buyer and a seller, and the price always juggles this matter. That is, the money always goes from the buyer to the seller and vice versa. That is, retail traders play a very important role in the graphics, in the market. Because there are a lot of them, they create the liquidity needed for this. And large players are huge whales. Or funds or institutions that have a lot of money. Too much money to just take and open longs and shorts, as you do it by pressing the buttons. Because when you do it, nothing happens. Although you can go, for example, to a crypto exchange, to some super little known coin that has just come out. And if you, for example, buy this coin, its price will immediately go up a little. Why? Because a buyer has appeared. That is, you and the price have pushed up. But if we are talking about some popular coins, for example Bitcoin, or Ethereum, or Forex, there are a lot of volumes, a lot of participants. And so it doesn't work there, you won't notice such a sharp movement. as on some little-known coin. Here and for example in Forex pairs, that is, on the euro-dollar, there is a bunch of large players, large participants who trade, who to open positions you need a lot of liquidity to do it imperceptibly. Good, they literally use the same formations for all these manipulations. That is, these are bytes. This is the removal of inducement. That's why it works great, why I always use it. Let's analyze this position on real graphics. This is Solana. 3 minutes time frame how I worked out such a deal. In fact, there was 1.5, but I just reduced the paper a little. There was 1.5, he will do the manipulation. That's how I am here, in principle. And I assumed, let's remove it. Now that is, we had this byte in the purchase. That is, bytes are impulsive movements that remove liquidity, and at the same time encourage people to open positions in the wrong direction. Look at what a beautiful shelf was formed here. Just a bunch of liquidity. A bunch here is this byte that all this removed, in fact. Let's mark it like this. And this is the resistance zone behind which all the stop losses were. These are the people who open such positions here. These are the positions for sale. That is, they put stop losses right here. For these maximum, because these are beautiful resistance zones. Price this whole thing beautifully removes and gives the opportunity a large player to gain a position in the sale. How easy it all happens. I just explained, that is, the people here are those who sold, they are closed by stop loss, respectively. They must buy an asset that was just sold, tried to sell. When a person sells, he does not have a point. Then he takes, let's say, in debt at the broker's exchange here. And he must buy it back only at a disadvantageous price. And when the price reaches his stop loss, there is a buy market. Automatically this whole thing is bought out. There are such applications here that select immediately the order of a large player to fill his sale, because in order to sell him, he must sell this asset to someone, and he, accordingly, must buy out this asset. This is exactly what these people do, who are taken here by stop loss. He calmly gathers himself after the manipulation of the short position, and here he conditionally fixes it. This can be seen immediately by the adjustments. Yes, on this whole liquidity, this is our liquidity, which was formed due to the fact that people here opened long positions and put stop loss here. There will always be there will always be a crowd of people, just millions. Market participants who will trade different types of support zones. Resistance trend lines like this, yes, and this is all their stop loss, this is all liquidity, and in order to close this short, he needs to buy it out, and buy it out from someone who can sell him so much. Of course, not one person can sell so much. This is a whole mountain of people. There are thousands, hundreds of thousands of people who will be able to sell it to him, who are small. Well, small traders, retail traders. They will be able to, if a bunch of people gather, if a bunch of people take their price by the stop, they will be able to sell it all to a player, and he will be able to get out of position. That is, when a person closes stop loss, here is a long position. He must, where he buys, enters the long. He buys an asset. If he is closed by the stop, he sells it. Well, the same is true just again. The difference is that here is a profitable price. Here is a non-profitable price. Here, he closes. They close the deal by the stop. They sell it. They must sell it to someone. Yes, the one who can buy out so much from them, such a huge volume, and a large player just buys out all this business from them and thereby closes his position in the sale, taking this difference, this profit, a huge profit, and the whole adventure worked great because he manipulated the topic first, so as not to noticeably take a position, so that the price does not fly down. Took this position, and then very competently came out of it using stop losses of those who opened longs here.